Hello, everybody. Welcome to week 7 of 2026. This is Mind Print Hash with myself, Cameron Otsuka, and with Matt Dines, as always. A lot going on in the world of monetary systems in the last couple of days. So Matt's going to take us through a deep dive across all of them. One thing to note is this is kind of happening a little bit in real time. So we're going to be pretty up close to the bleeding edge of the news, but obviously by the time you see this video, maybe there's new developments, things like that, and we'll make sure we touch on those next week if necessary. But to start us off, I'm going to flip us back to the presentation view here really quick, just to let Matt kind of explain this image he put together showing G, and maybe Matt, I'll just throw it over to you. Explain kind of what your thought process was behind this image.
Yeah, so good images should need no explanation. So I think you see Xi Jinping as the obvious one everybody can recognize. Mountainous pile of gold on the conference table. And then the guy on the right is the AI's rendition. I think this was actually Perplexity because Grok was down. But the figure on the right is supposed to be John Maynard Keynes. And the idea here is a Bretton Woods Redux agreement, basically just rehashing here. So I'll try to make sense of that for people. What's going on between mainland China and I'd say the UK really, in terms of the monetary transition that's unfolding. So that's what's going on in this main painting image, supposed to be the 1945 classic BW conference, Bretton Woods. Notably where you had the UK engaging with the American political and financial leadership that notably took place after FDR, which massively changed the game in terms of how history unfolded, in my opinion. FDR died while in office, just for to set the context there. But yeah, so we'll get into that in a second, try to explain some of the things that have happened in the last week in terms of how the puzzle pieces have shaped out in the big picture context of what this period of monetary transition we believe we're living through. Number two, U.S. LOLR is lender of last resort, for those not familiar with that acronym. But yeah, LOLR, the central bank's kind of legacy role it's been asked to play in a monetary system really since Walter Bagehot laid it out in the I think it was 1860s actually, how the Bank of England functions and how the kind of the City of London paradigm of how a central bank is supposed to operate. And then third, everybody's focused on AI this week, the sell-off in software. Everybody is probably well acquainted with the blood in the streets hitting software that's being disrupted by AI, mainly SaaS, 2010s era VC developed companies projects. The equity is not performing well, to say the least, these last few weeks and months. Same thing with Bitcoin there, on trend, following that big liquidity suck down. So Cameron, you want to get into it? Let's go over and just jump right in. I
Yeah,
think this
let's do it.
story did not get the headline attention from financial media that deserved. But starting last week, we started to hear Xi Jinping call internationally for adoption of China's RMB, also goes by the name of the Yuan, to attain global reserve currency status. Now, what do we mean by this? We'll get into that in a second, but some things that are associated. If you do want to have your currency of your sovereign nation be used as the reserve currency in international trade, investment and foreign exchange markets, there are certain things that you're going to have to be asked to provide to that system in exchange for that ultimate privilege. So what that would mean would be like it would have implications for the PBOC, just how the monetary structure kind of evolves in China. But in my mind, Cameron, if we go to slide 3, when you look at the chart and you see these would be the fiat currencies held and reserved and kind of capacity of international reserves. These would be central bank holdings compiled by the IMF. See, the U.S. dollar still commands, the majority market share of fiat central bank reserve. Uh, Far behind that, maybe a third to a fourth would be euros, and then just a tiny, tiny sliver would be the China's CNY. Now, I don't think that's actually the way this is, or this is what Xi Jinping's talking about per se. He's not competing head to head with a fiat dollar standard or the offshore dollar standard, to be more specific. What we're actually looking at, if you now add gold into the arena, you start to see the same trend with those fiat credit FX currencies competing with gold, and you've seen since basically the mid 2010s, that 2015 2016 oil crisis, all of that collapse of U.S. shale producers, Saudi production turns on the taps, and we also saw a devaluation from China. Basically the low point and the post GFC kind of global growth. In regards to that legacy offshore dollar and international trade system framework that had really been in place since post-World War II, which Bretton Woods was the key part of settling how FX currencies would work. I'll get into that in a second, but you see the rising role of gold, and it's not the euro, it's not the Chinese yuan that's taking away international reserve currency status. I mean, maybe a tiny sliver of Chinese yuan,
Barely though,
and
but yeah.
yeah, that can grow, but it's really gold eating the market share. So go back to the Bretton Woods conference. I'm not doing the Zoltan Pozar Bretton Woods 1.0, 2.0, 3.0, that type of thing, but Bretton Woods 1.0, what was agreed upon? Going into World War II, you had everybody, every nation state essentially sever the link, the redeemability of their currency units or their banks IOUs into a metals commodity, which was everybody was on the gold standard as of 1930s, except for China, silver. Um, we'll ignore
I
that
think
piece
that's a
for a
good deep
second.
dive to go in
Yeah,
if you're interested.
that yeah. If you want to read more on that, just read Xin Zhu's Empire Silver that I talked about. Um, but what was agreed to at Bretton Woods conference in New Hampshire was basically that the U.S. dollar itself, in the institutional context, would be redeemable into gold, um, and then all other FX currencies in the Western bloc that emerged from the victorious World War II order, basically everything non-Soviet Union, all currencies in the Western bloc. So you think about that today as kind of your Eurozone countries, U.S., Canada, Japan, um, kind of Taiwan. That one's debatable. Um, don't want to get into the the conflict between China right there, uh, Australia, etc. But all of those currencies were then redeemable into the dollar. So what you had is kind of a loosely pegged system. It all filters into the dollar, and that's where you saw the emergent offshore dollar standard emerge. And then ultimately, you kind of layer down, and your base money is the gold bars sitting in, could be London, could be New York, etc. But and then international banks could then redeem and take delivery of gold between each other. Now that system ended hard cut off in 1971 with Nixon closing the gold window. Like the other side of that for the everyday real economy, domestically inside the U.S., you actually had the U.S. on a quasi silver standard as well. Go back and look at your dollar bills pre 1968, the Silver Certificate Act. All the dollar bills were not actually Federal Reserve legal tender notes, like as we pass around in the U.S. between each other. I guess it's becoming less and less frequent as I don't know about the audience, but when we go somewhere in Seattle, it's not uncommon at all now to see, a restaurant, any establishment post like cash, they mean Federal Reserve notes paper money are not accepted in this fine establishment. I see that all the time now. So that's just aside. But up until 1968 in the US, you were like your paper money was not a liability of the Federal Reserve system itself. It was actually a redeemable note into silver at the US Treasury window. Now, you, me, mom and pop, we wouldn't go up to the Treasury and redeem for,
Knock on the door.
the defined weight of silver. But if you're a bank, you can collect those and you could go redeem them for silver. And that's where you actually saw, figures like Henry Jarecki as early as the 1960s. Once they realized with the 1968 Silver Certificate Act that the U.S. was going to break the precious metals linkage of the U.S. dollar unit, both domestically and then close the window for onshore to offshore redemptions in gold. That's when you saw like over 1 decade, like secular bull market in silver as that currency unit linkage to the precious metal broke effectively. And then you just see that you see it in this chart right here, the expansion of the dollar and reserve currencies or in international reserves. Dollar expands, it really peaks in 2008 with the GFC. And this kind of just echoes what we've been talking about every week on Mind Print Ash. We're working towards the new. So this week, from Xi Jinping in the headlines after, the visits from Mark Carney, Keir Starmer, Gavin Newsom, everybody in the old school globalist coalition is what we'll call them. Think about, when you hear globalists, like they want to replicate the same basic framework, try to copy and paste it onto, new players and have that system continue to work just in a different configuration. I believe that's what you're seeing here with this headline from Xi Jinping, and then another one we'll get to in a second. But in my envisioning, what we're seeing here with gold emergence really echoes. Think about it, Bretton Woods, where the UK suckered, in my opinion, the American delegations to go against their interest and become the hard link at the center of the Bretton Woods system. China is now being asked to fulfill that same role as well. So in this globalist architecture, just swap out the US dollar, swap out the Federal Reserve, and the infrastructure that FDR laid in place by, an update to the Fed in the mid 1930s, instead of just 12 independent regional branches that would, cross settle with each other, representing the sub economies within the United States. You just had one centralized man in the middle Fed in Washington, D.C. to rule them all, and then operated with the most powerful regional Fed, which was the FRBNY, Federal Reserve Bank of New York, to run this international gold settlement window. So what you're seeing right now, this international reserve adoption of the Chinese RMB, really, in my mind, echoes, it's a copy paste of the general system that was laid in the post-World War II order. But now you're looking for mainland China to fulfill the role on behalf of,
Right.
the system, which wanted to pursue international trade, globalization, et cetera. Now China's going to fill a different role, which, in my opinion, is probably not compatible with the Chinese economy as it's been structured since kind of the Deng Xiaoping reforms in the 1980s, so post-Mao. So this is going to be interesting to play out. I'll get into what this means for Chinese imports and internal domestic consumption in a second. But start here. Gold stock in tons. Everybody's been following this chart as we've been in the secular gold market. What's happening? Well, you're seeing this ramp up in terms of gold inventories available for warrant on the Shanghai Futures Exchange. What this represents to run this system and do this copy paste. You're going to need a significant and sizable and sufficient just volume of gold inventories to manage the renminbi that would serve as an international reserve, right? So this is all starting to click in place. I didn't necessarily see China going this way, but I think in the last 2 to 3 weeks, it's become more and more clear with those visits from Newsom, Carney, Starmer, et cetera. Now, in terms of who has the upper hand, that one I do not know. Mainland China may be doing this because it doesn't have a choice otherwise, just given the layout of its own um, economic backdrop. So this may
Saying the
be,
economy is not doing well in China right now, right?
it may not be. I'm not exactly, sure on that read, but if you wanted to keep operating as China, just status quo, the economy and the kind of the growth engine, which is largely just driven by manufacturing exports, dump your surplus on the rest of the world, suppress the value of the Chinese yuan and international foreign exchange. So forced technology transfers, IP theft, all of the above that you hear. Those who would take the other side and claim victimization on this trend. Those old ways probably aren't compatible with, I think, this new vision of what Xi Jinping is expressing. All right. So next step, Sunday night. This was February 8th. I recall picking up this article that dropped that China, or mainland China's financial system regulators had begun to urge banks to lower their exposure to U.S. Treasuries from a standpoint of panic. What would you call it? The blackpilling, de-dollarization trend.
Right.
This kind of leans into those fears. But I viewed this from a different lens, right? It's very clear that the U.S. is not on board with everything we just talked about, like a new Bretton Woods, just replace U.S. with China. That's not the direction U.S. wants to go, obviously, or it's not going to take part in terms of leading the way on the system. Let's just say that. Um, if if you think about this from an FX standpoint, what you would do for your banking system if you were going to allow the Chinese yuan to appreciate in global foreign exchange markets, this behavior saying, hey, reduce your exposure to U.S. Treasuries, but you would also, if you're going to revalue the Chinese yuan upward versus other FX, you would treat this the same way, whether it's the euro, Japanese yen, et cetera. But U.S. Treasuries are the predominant international reserve holding. So it becomes first and foremost, hey, reduce your stock of those because we are going to allow the CNY to appreciate on global markets. That is, consistent with this kind of underlying story that we're framing. If you do want to have a gold-backed international reserve currency where instead of gold vaults at Fort Knox or Federal Reserve Bank of New York, the redemption window is now instead on the Shanghai Futures Exchange, which those are the charts we just showed, right? Those numbers going up and to the right.
Yep.
You're going to have to let the yen or the yuan rise in value, which makes your domestic growth engine, which has been primarily tied to manufacturing exports, right?
Exports, yep.
Out of Hong Kong, Shenzhen, et cetera, just boom over the last 40 years, which is part of a multi-century story in terms of Chinese export-led growth. You're going to have to allow your currency to appreciate, which is on net going to make your manufactured goods non-competitive in the international trade market, which they don't care. If you're in the business of loading up ships and taking goods from A to B, you're purely profit driven maximizers, and at the end of the day, what's going to matter is can you derive profits by picking up goods in Hong Kong, shipping them to Port of Los Angeles, vice versa. If the dollar is now weakening just across the board, including Chinese yuan, the direction of travel for those goods in international markets now shifts, and you've turned what was a 40-year headwind, or sorry, tailwind, let's say for China as the manufacturing center of the world. You flip that on its head, and the trends now reverse. So this doesn't change overnight. You're not just going to suddenly see these supply chains, all of that break at once, and global shipments, et cetera. Supply chains take a long time to build. International trade relationships take a long time to build. But over the course of multi-decades, I think what you're even in the last week is really an establishment of where this system is heading for the long run. Now, so we talked about allowing the Chinese yuan to appreciate. That's exactly what we've seen since basically Liberation Day. You see the peak right here, up around 7.3, 7.35 CNY to the dollar, really in line, tapping a level that it's hit a few times in terms of weakening since 2022 and the rising rates environment. But you've seen since Liberation Day, Chinese yuan has been appreciating versus the dollar. Directionally, that's where it seems like in the big picture, multiple years, decades, et cetera. If China wants to become the international reserve currency, which now you've heard from Xi Jinping himself, that's the direction of travel, in my opinion, to keep watching. All right. Now, another headline. This is where this week has just been like, all right, imagine this is
back.
yeah, imagine this is like a matchmaking, I don't know, I'm just thinking of like a debutante ball in the 1700s or something ridiculous. And everybody's there trying to find a pair. US, who are we going to do business there? Russia's there, UK's there, China's there, etc. Everybody's just trying to find their dance partners. And this is just really weird. Over the last 3 years, what have we heard? Like ever since the Russia-Ukraine conflict has really entered its new phase, taken on the kinetic, profile. You saw things like Vladimir Putin and Xi coming out at conferences, handshaking, hugging, etc., saying this is the partnership without limits. You even saw, we'll get into the story, I guess we'll show it after this, but I'll just go forward one, Cameron. Russia gears up for yuan bonds in sight of tighter relations. November 30th, 2025, right? So Russia was, as recently as like 8-9 weeks ago, going to start, issuing bonds on this CNY standard. And then you'd see to like the matching transaction there on the good side would be Russian gold exports into China, just kind of echoing that theme of the gold, backed Shanghai Futures inventoried Chinese yuan, right? Russia was gearing up to fund itself in its war effort on Chinese yuan denominated debt, right? This week, however, this is last night, February 12th, or early this morning, we see this headline floated that, sourced from the Kremlin itself, there's a memo circulating written this year saying a return to the dollar system in a pitch made for, the Trump administration. So we didn't talk at all about what this new dollar system is, but, leaving that aside for a second, Russia is now saying, hey, or at least in this signaling, if you're a flirtatious attendee of this debutante ball I talked about, you're saying, hey, my dance partner was CCP, but I'm also going to come over here and flirt with the United States and this new dollar monetary order that is emerging. So this whole gold back yuan we talked about, the Chinese international reserve currency, et cetera. You've also got a new dollar system emerging as well. We'll get into it a little bit with our next story, but this just signals right now the everything is still in motion, right? Everybody is still working out and finding their dance partners. I do think in the last 4 to 6 weeks, the relationship between the UK has, in terms of international trade, has been, I'll just call it like a codependence, right? Mainland China has relied on the UK for its own export-driven growth and economic stability. UK has relied on China for financing its own long-term British Empire. Ever since, slightly after the days of Colonel Drake. But it's been a love-hate relationship, I think, is a good way to characterize it. It can range from good, when times are good, to just downright awful in terms of, maybe everybody has that friend who's in that terrible relationship that they just won't get out of. Look at the Opium Wars. You had some borderline inhumane, no, not even borderline, like forcing opium addiction upon the Chinese masses because of a silver shortage on the UK banking system's part. Basically, if you go back, you look at the supply lines, international trade, everything. China didn't want anything the UK had to produce. They wanted its silver. They wanted the New World silver that had really been discovered and expropriated for the European powers out of the Americas. That led to a rise in I guess silver inflation in terms of the monetary stock. And it turned out, well, the UK and Europe's insatiable appetite for Chinese porcelain, silks, manufactured goods of the 1600s, let's say 1800s. All they wanted from the New World was silver. And once that new stock of, I'm just shortening the story here into the TLDR version. As always, there's going to be more complexities in this. But as soon as that New World silver supply ran out, China or the UK realized they had a problem, and they needed to fill it with a new product to introduce into the Chinese market. That product was opium. Very similar rhyme and such to what you see in the U.S. today, in my opinion, with the fentanyl problem that is hitting the U.S. So obviously, China didn't like it. It was kind of, as we said, in that relationship of codependence. It couldn't, or the sovereign state couldn't survive without the international trade mainly out of southern China, and that relationship with through the UK as middleman, and its engagement with external consumption markets, right? So ship its tea, Chinese porcelain, silk, etc. And that led to basically the Opium Wars, as China itself, the governing leadership tried to fight back and basically stop this drug addiction pandemic. As in the mid 1800s, there were two of them. That led to all-out war, right? And ultimately ended in a full defeat of the Chinese government at the time, and they really kickstarted that what Mao called the century of humiliation, right? That ended with the kind of the nationalist era under the banner of communism, kind of the dominant nationalist paradigm of the time. And then you had the emergence of communism with Chinese characteristics in this modern day CCP. Now, what you're looking at here, the century of humiliation, coming out of that, China isn't necessarily saying, from the standpoint as I read this from the leadership of Xi Jinping, they're not saying we're done with the UK, kind of the way that I think you saw in the communications from the US leadership at Davos. When I say done with the UK, I mean done with globalism, right? China is more dependent on globalism, but what it's saying now, and my read, is we're going to now be the central role. And as it nets out, what I view this as is basically the mainland China, government out of Beijing, willing to acquiesce and be the hot swap, if you will, for the U.S., which no longer wants to serve as that subservient role as the international currency. So, what this means for China in the next decades and the rest of the 21st century, like this is a defining decision. But for the U.S.'s standpoint, like it's going a totally different route. And then this other story you see from Russia is also a very interesting signal because what did we used to see? In prior, it was really tight coupling um, between Russia and China, and basically solidarity on the giant land island that is the continent of Asia. Um, so I think the takeaway from this week, there is a lot to be seen, but don't assume that all the partnerships are set, I guess, until it's all said and done. So very interesting week. Now, finally, what does this mean for the domestic U.S.? It's just a post from Brad Setzer, you know, uh, um, really high profile economist for, oh, I can't, who would he be for? He's not for the IMF, but anyway, he's just for consensus,
CFR.
CFR, I was going to say Council on Foreign Relations. Okay. Yeah. But he's basically the FX international trade expert, if you will, or one of the preeminent experts in that field. And basically, he's calling out here. I mean, look at these charts. These are, just the last 5 to 6 years of data on Chinese exports versus imports. And you look at, the red line obviously going up and to the right. This is just in line with or consistent with the legacy framework or just standing economic plan of export-driven, Chinese economic domestic growth. What this is saying as international reserve currency, or if you do want to, go that route, if you're the incumbent leadership of China, you look at that flat line on imports. What that is representing is the lack of demand in the domestic Chinese economy. If this is the path that's taken at this fork in the road we're at, you're going to have to see more consumption out of the Chinese households and consumers. So that would be a remarkable shift from what we've seen in the last, let's say, 150 years, long-term timeframes. But if you go back and read Chinese history, like that book I mentioned, Qin Shu's Empire of Silver, you definitely see examples where Chinese culture skews towards, I guess what we call it, Epicureanism, right? Just going after, chasing luxuries, all that stuff. Really similar to what we call or what we observed in, I think, the West and the U.S. market itself. Just conspicuous consumption would be an example of that trend. So these are big picture kind of changes that are in place, but we're starting to see the headlines of not just major monetary shifts, but to make that monetary shift functional, if you will, for lack of a better term, you're going to have to see a change in, I think, what we've thought of as Chinese culture, which right now, coming out of, I would say something that was worse than what was experienced in the United States from the Great Depression, right? That paradigm or that mindset of thrift. You hear about, my grandparents just recently passed away, and you see in the obituaries like child of the Great Depression, just extremely thrifty, very resourceful, no waste, etc. Well, the opposite of that is, just kind of decadence, high consumption, etc. You can swing societies on a dime, and I'd say like if Chinese culture was at one pendulum, well, this would be one of the necessary conditions to make this shift happen. What you would watch for is like just an increasing focus in terms of global growth and reliance towards the Chinese consumer, domestic consumption. So keep watching out for that. Major things are in store. All right. So we talked for a little bit.
Yeah.
Yeah. Let's talk about, yeah, the changes. We talked about the dollar system because this is not happening in a vacuum. And the US is building up a new dollar system unto itself, something that is going to be different than this offshore standard that has really predominated since, you could say, going back to 1971, where Nixon's decision to turn off the gold window for institutional redemptions basically just turbocharge the growth in terms of credit expansion and the offshore dollar framework. But it's been underway since 1945, really, since all international trade and settlement and the Western powers that emerged victorious to World War II basically just steered all economic activity into the dollar. Well, there's a new sheriff in town. This process started, we've talked about, with the implementation of SOFR and the tri-party repo settlement structure in 2018. One of the key pieces this week, in terms of that lender of last resort function, in terms of like a credit system supporting itself, was brought forth this week in the House in HR 3390. So this was legislation really pushed for by the American Bankers Association lobbyist group, but what this act is calling for is basically the legislative branch, and then I expect the executive is going to also sign this. This will not be vetoed. They're going to require the Board of Governors of the Federal Reserve System to basically modernize its discount window lending program. So old school discount window, this thing's been around for, I mean, several decades. Like, just think about it as ancient for all intents and purposes. What this does is, if you're a bank and you're in trouble, like you're facing a pinch, you're borderline insolvent, and you need access to dollar capital to meet your liabilities. Let's say the market won't lend to you. You can't obtain dollar capital. Well, if you're a bank inside the Federal Reserve System, you can go to the discount window, borrow dollars from the Fed, this Fed funds rate type borrowing, and obtain that capital you need to hopefully, survive your pension and stem off a failure of your bank. In a sense, like, the mechanism for this system is not built up for the basically the speed and basically just throughput, processing, et cetera, of transactions that the pace of banking in today's economy just demands.
I was gonna say too, I think you can
Yeah,
imagine, just based off that definition, the stigma. I mean, if you just type in discount window, search for that in Google, first thing that pops up on every search result is stigma around using the discount window. The way this is designed today, it's
yeah.
pretty
It's a
tough to tap
it's
that.
it's basically like there is no good way to say this. Like, it's basically just your announcement of an obituary before it happens if
Right.
you utilize this facility. And you can see in every banking crisis, at least since 2008, the discount window has been borderline ineffective or irrelevant, right? With, like, discount window didn't
Silicon
solve the
Valley.
problem in 2008.
Yeah.
And then what happened in March 2023 with the mini crisis for regional banks, that everybody today should be able to recall. It's only 3 years ago. Discount window didn't play a role in providing the lender of last resort liquidity that you would want it to in the Walter Badgett framework, right? Lend freely at a high penalty rate. Lend freely against good collateral at a high penalty rate, right? Is the general saying of how this should operate. And so in March 2023, what you really saw was a utilization for that last resort liquidity need of the Federal Home Loan Bank program, which was probably not exactly designed out for this specific capacity, basically to provide the emergency liquidity financing into the banking system. One of the drawbacks of the discount window, you can only borrow on 90-day terms, versus FHLB could or would allow for longer term borrowing. And then discount window and other liquidity facilities, you could even say SOFR or similar markets today, same general problem exists. You're looking for, U.S. Treasury or similar like agency bond collateral to post as your, basically good money to borrow against to obtain access to that emergency liquidity financing. With FHLB, they could extend against slightly different collateral, say more terms of real estate loans that a commercial bank might hold. But really, what this HR 3390 is asking for is basically bringing up the technology to where we are today, where instead of requiring a phone call for yes no approval on collateral, a very manual high touch process, that might take several hours, a full business day, afternoon, maybe even going on to a few days for a determination to be made on, hey, what's going to be accepted from a bank's balance sheet as lending collateral. The idea here is to use modern day technology, software APIs, et cetera, but then also some standardization. You could talk about like this tokenization trend. Basically, you'd be able to ping in real time, show your loans, show your collateral, show your assets as a commercial bank, and receive that financing or that liquidity in real time, seconds, minutes, et cetera, rather than hours. And we learned with Silicon Valley Bank that bank run doesn't even need hours or days,
Right.
to play itself out. That bank run happened like within a couple of hours or minutes. So basically what you're seeing here, talk about an apolitical Fed, like the definition, like Congress is doing its job telling this, quasi public institution, which the Fed is not, what it needs to do to get its act in order. This example of HR 3390 is exactly that. Like, get up to today's standards. We need to, revitalize our own, domestic dollar system, rebuild this thing for just call it the new dollar framework. I don't know. It doesn't have an actual term right now, but it's basically the way to call this elephant in the dark that we're all living through, right? We all just call it de-dollarization right now because we think about it in terms of the end of that old world dollar
The new
standard,
state. Yep.
which is basically just tucking the Fed dollar and the Bretton Woods dollar under the Bank of International Settlements global money cartel, right? That's the de-dollarization that's taking effect. But there's also a new dollar that is emergent. Part of that is obviously the Genius Act, stablecoins, et cetera. But deep topic to get into. We're just focusing on one piece of it right here. This passage of HR 3390 is a key milestone in that step, right? Bringing the Federal Reserve's definition of a credit dollar into the 21st century. That's going to have to play well and sync up with what you're seeing take place with Genius Act stablecoins. That's going to be a big story that unfolds. Now, part of this dollar system that I'm talking about, this emergent new dollar, if you will, you see it in the trading blocks with the other kind of nations where you've seen this sovereigntist movement turn on. We talked about last week, the big story of last week, the Japan elections on Sunday, saw Takaichi's LDP government come in. We talked about the four levels to hit, starting with the simple majority, 50% plus one, right? That's the weakest parliamentary majority that would be possible versus the strongest would have been the supermajority, the 2/3 control of the Japanese Diet, which allows for, basically we called it like 3 yards in a cloud of dust football, like whatever you want to do, we're just going to run over you. You can't stop us. That's what they got. They got a 2/3 supermajority. They could, if the political consensus exists within the LDP faction, they can now modify the Japanese constitution that was kind of implemented, could say, within Japan, but really upon Japan, I would say, in the 1945 aftermath of World War II. Right. Okay. So you've got this new dollar system kind of emerging. Who is turning on in this block, right? Well, you got the U.S., obviously, assuming the tug of war between the sovereigntist movement Trump, populism, etc., is kind of, riding behind. Japan turned on. They're sovereigntists now. I would say Argentina as well. They're turned on. You can see this in South America. I think it's an emerging trend to watch. You've got some major elections this year in Brazil and I believe Colombia. So keep watching here. Um, but in terms of that trend, one of the key things supporting that is you've got to have um, basically control over domain of settle pricing and settlement of the international commodities trade, right? So what are commodities? Like by definition, I would say, or like what would satisfy the definition of commodity? I'd say it's basically a good that every society or the knowledge of ability to produce said good has distributed widely across enough, societies across the globe that the marginal profitability has basically been squished to a minimum, right? So you think about right now, what is not a commodity good? I would say like a very complex NVIDIA state of the art, like Blackwell semiconductor architecture, Taiwan Semiconductors, chip on wafer on substrate, architecture, et cetera. Those are things with, the steps and a significant degree of knowledge, high capital intensity, Joe Schmo can't just start, mastering that process next week if he wants to go into production. That's the opposite of a commodity, right? Commodities, things like oil extraction, mineral resources extraction, et cetera. Anyone can produce them so long as you have the supply, and you load those things onto shipping containers and float them across the the ocean, and you trade those from A to B, and now you get back to where we were beforehand, talking about international reserve currencies, right, and new like systemic paradigms. My point here with this new dollar, one of the key things you're looking for, you've got to retake that settlement venue, like own that domain of pricing and settlement, where kind of that trade in international commodities, cross-border, inter-nation state, all of that takes place. And so what you see here in the story this week, this was not covered much at all either, but this was on, I believe, the CME earnings call, just the C-suite executives talking. I believe it was the CEO mentioning they're working on a tokenized cash coin developed with Google to roll out this year for crypto collateral. So what does this mean? We talk about stable coins. We talk about the venues, right? The CME as a commodity exchange where, buyers from foreign countries, if you want to go put in your order for the very raw materials and most basic complex goods, but you can also like you can buy oil futures, other commodities, agricultural commodities, energy commodities, metal commodities. You could also buy financial commodities, treasury bonds, interest rate futures, SOFR, all of that. But what this story is showing in terms of that settlement of that kind of base layer of the actual goods economy in the real world, that settlement is now being looked to kind of like base or build downwards onto a base layer of this tokenized cash coin future that we're talking about with Genius, Act, stable coins, etc. This is a very Rube Goldberg way, in my opinion, to get to a liquid cash settlement system on a crypto layer. If you go back and read Satoshi's white paper, Bitcoin, an electronic peer-to-peer cash settlement system. I think I got the full title right, very close if not. We already have a tokenized cash coin. Like it's as simple as you can get it. I just don't think the knowledge is there yet. That ultimately that's where this process leads in terms of the only solution. I guess you could make others, but it's the most liquid, deepest, furthest adopted. Call it peer-to-peer cash system.
I think the incentives too, right, are to try to find a way to insert yourself somewhere in the
Yeah,
middle of that to try to extract a little bit of extra value for yourself. So there's
yeah, but I didn't finish my statement
Yeah,
there. That solves the Byzantine general's problem, right? So that statement there, what is the Byzantine general's problem? I'm not going to explain that. It's going to take us an hour, but that's the core thing. And Cameron, as you just mentioned, if you can just hop in the middle and extract some of that value, that's what we're trying to do here when we're saying, hey, we need CME Group Google tokenized cash coin. That's what we're trying to get to, but ultimately you can't compete in my mind with that disruptive innovation on Bitcoin as settlement rails.
100% agree. Yep.
That we're still playing through, right? This is going to be a messy process for everybody to figure out. The other thing too is there is an element where you've got to port over the legacy solution onto a new platform. So I can see, the migration over from one system to the other. It's a process that's going to move in terms of, multiple steps. You're going to need some, yeah, catalysts along the way to add energy, get the system to move states, to get value, over here in the incumbent system all the way over here towards what we're building towards. But what we see in this headline from CME Group out of their earnings call is, I believe, right on point and telling you where this dollar settlement needs to go. I was talking to a good friend involved in the Bitcoin space, and they do a lot of venture funding for companies building on the Bitcoin rails, a lot of investment into the monetary infrastructure. What I said here, we talked about the importance of bringing that pricing and settlement of commodities into your sovereign systems domain. I think what we're seeing in metals, right? We talked about in the metals volatility and boom and bust we're going through, and let's say silver, platinum, palladium, all the above, as pricing venue moves from, let's say, Switzerland and London towards the Americas, Chicago, New York, et cetera, and onto these rails. The movement of, starting with metals, right? That's billions of dollars in daily settled transactions. That is going to move onto this new dollar architecture, or at least as the war that is playing out in real time. But the next thing I believe you're going to see, the next move, and this is written, this is in the headlines already with what we saw with the actions this week, Venezuela, Maduro extraction, et cetera. We're next moving oil markets and global energy trade. I think you can include liquefied natural gas in that process, but that settlement venue is also being absorbed and kind of what I just call like supplanted and moved from, let's say, London, the Brent crude contract, into the United States for, let's say, WTI or similar pricing mechanisms that price set energy commodities based on the U.S. and the Western Hemisphere's marginal production, as opposed to, let's say, Europe's or London's. So big story this week in the CME as well. Continue to watch. And then last, let's just mention Google did a massive bond offering. Part of that, it was multi-currency. It was US dollar, British pound. I think it was also Swiss franc. I don't think the euro was involved. But this goes to the AI build out, right? We all know, everybody's heard the stories the last 3 years. AI is just going to consume a massive amount of dollar capital. You're talking about trillions of dollars in equity and credit financing to just keep this build out going. This week, Alphabet launched a deal in the U.S. I'll get into that in a multi-tenor deal in the U.S. dollar investment grade capital markets. They followed that up early in the week in British pound markets, and I think the notable here was the GBP markets were willing to issue Google a 100-year bond. These are not all that rare, but they generally tend to, like, 100-year or long duration issuance tends to, or interest in them tends to spike as interest rates are topping out or on their way down. Growth concerns come into play. We talked about this in the Gordon Pepper framework a little bit last fall. We'll keep citing that, in our week-to-week commentary. But basically, like, once you're past that point of peak of the boom, if you will, commodity prices and inputs into production tend to rise in price. Growth slows out as kind of the marginal bidder at these kind of, just think of everything as an auction for those inputs, starts to just taper off. And interest rates tend to fall as that growth is in decline. So what you see from savers is just a willingness to extend further and further out on credit and duration to maintain their nominal incomes. And so part of this process, as you're getting late cycle, is you tend to see more and more long duration bonds picking up as short-term interest rates and money markets really just continue to decline towards their lows. So the other side of this that I found extremely interesting, if you think about, okay, you can see this in the US 30-year Treasury markets. Yields have been falling pretty precipitously these last couple, since February, right? We started at 4.9, 4.93, 4.92, something like that. And they've just been in decline all month. You've got long-term interest rates falling almost 20 basis points in a matter of, a little over a week. I would argue that's very similar, two sides ahead, Cameron, to what you're seeing, this deflationary scare hitting the SaaS software sector, the often doom posted charts you'll see on the IGV, iShares, software, cloud computing ETF. This disruptive worry that, hey, wait, AI, while enhancing productivity, this is actually going to be deflationary. So you're seeing now is this market, which through volatility, pockets like we're in, I can say it. AI, how the market's going to react, how human society is, going to integrate these technologies, what it means for our future. All of that is kind of up in the air. We're just going to have to see how it plays out. This week, we're especially recent weeks, the deflationary worry has really, in my opinion, taken hold. So remember 2023, 2024, if you throw an AI headline out there, it was bullish. Like you just mentioned AI in your press release as a stock, you're like, that's a buy, like just bid.
Looking into whether
Lift
AI is
the
helpful
offers.
for us. Yeah.
Yeah. Now, since the beginning of 2026, especially, you throw AI out there, you put AI in a headline next to a stock's name, you'd be like, sell. Now it's become, it's literally flipped from euphoria and AI towards we'll just call it like panic. Oh no, this means my business is destroyed. So it's just this kind of massive state of confusion. But if you're thinking about an interesting bet to make, right? What is your bet on, if you buy 100-year duration, very like almost all the time in history, we can go back in examples here, but rarely ever has it ever worked, especially on a fiat, managed ledger with like nothing redeemable for that monetary unit, to lend money on 100-year time frame on, the coupon on that Google bond is about 6 1/8, I think.
Yeah.
Is that investment going to keep up in its real purchasing power terms? Odds are highly against you, but if you're betting on this deflationary panic, as we've been in the last few weeks, then you start to see just the demand for long duration, corporate debt, tied to this AI trend, which that's what the capital proceeds are going to be used for. Data center build out. Google's going to, continue developing its Gemini models and so on. But in the US, you did not see demand in the US dollar system for 100-year bonds, but they did get a lot of 20, 30, and 40-year demand. It was roughly, of the $20 billion deal, it was probably about a third, right? And it was very well subscribed. So you saw it covered anywhere from 5.7x oversubscribed on the 20-year tranche to, on the low end, 4.5 subscribed on the or covered on the 30-year, which was the largest chunk at $4 billion, and then 5.5 covered on the 40-year tenor So still a lot of demand in the US dollar, but I think there's not that same panic over growth that you saw in, maybe a slower growing economy like the British pound represents. So let's leave it there. Let's close it off. A lot of things in development this week. A lot of these stories were undercovered in the financial media, but
Great.
hopefully
Yep.
this gives you some context today.
Absolutely. Well, as always, thank you, Matt, for explaining that and going deep on kind of that entire set of trends there, and hopefully that was useful for the audience here. We'll be back next week with week 8 of My Print Hash. As always, please follow us on Twitter, on YouTube, or I should say X now, not Twitter, and anywhere else. I think we're also
The, the
heavily posting on
Substack.
Substack. Yep.
Yep,
So
there you go.
please find us there as well. I will probably be building out a better kind of ending here that we can just plug and play, make it a little bit easier for you guys. But in the meantime, go ahead and find us on all those platforms.